When it comes to investing, we are our biggest enemy. Excited by profits and terrified by losses, we tend to let our emotions and mind trick us into making terrible investing decisions. Everybody knows they should be selling high and buying low, but our mind is telling us to buy when things are high and sell when they're going down. This is the classic fear versus greed fight constantly happening when making investment decisions. Hi, my name is Darius Muica. I'm a senior investment advisor with Nor Private Wealth. If you are new to my channel, I focus on helping Canadians safely build wealth and pay fewer taxes. In today's video, I will tell you what the most common investment mistakes are and how to avoid them. The first one on the list is the fear of missing out. Whether it's GameStop, Bitcoin, marijuana stocks, or some other market fad, people often buy into an investment not for its underlying value, but because they see everyone else buying it. The more investors crowd into a hyped investment, the faster the prices soar, and it causes others in turn to break their discipline and replace their investment philosophy with what they hear from social media and the news. To make matters worse, in the past year, a whole new crew of novice investors started speculating on the market. You know it's bad when you hear people on Instagram and TikTok giving investment advice and sharing momentum strategies. By the time you invest in whatever is trending, it's too late because professional investors trade the instant that news break. Individual investors should buy and sell based on the fundamentals of an investment, not the hype. The second investment bias is overconfidence. Aristotle famously said that the more you know, the more you realize you don't know. Some investors tend to overestimate their capabilities and believe they know better than anyone else what the market is going to do next. They believe they know better than suggested evidence. One comment I heard often in the past year was that President Biden's plan to increase taxes will trigger a market crash when in fact, the year before a tax increase, stocks went up 12 out of 13 times in the past 80 years. To avoid overconfidence, build in a delay before you buy or sell an investment so that the decision is made rationally. For example, create a watch list and wait a week to see if you still want to buy or sell. Overconfidence sometimes goes hand in hand with confirmation bias, which is the predisposal to notice and focus on information that confirms our beliefs. We have seen this 20 years ago with the dot-com bubble, followed a few years later by the real estate craze, leading up to the financial crisis and perhaps Bitcoin these days. When an asset holds promise for riches, and the news and social media are filled with stories of people making money, we tend to dismiss negative news. If you think Bitcoin is a good investment, it is easy to find and focus only on information that supports buying it. To combat this bias, you should actively look for information that contradicts your beliefs and imagine what you would advise a family member to do in order to protect their interests. The third investment bias is loss aversion. Our brains naturally tend to feel pain more strongly than pleasure. As a result, we tend to act more irrationally to avoid losses than we do to pursue gains. Too often, we lean into the negative things we've experienced, and that shapes the way we think about investments as well. When shopping online, most people look only at the few negative reviews and ignore the hundreds of positive reviews. When markets are going down, investors want to sell because they are worried of losing even more. They will forever lock in those losses and stick with GICs because of their bad experience. To overcome this bias, you should be okay with embracing a little volatility. Have faith in your long-term investment strategy and think of volatility as an opportunity, just like a sale or a promotion at your favorite store. If that is still too hard on you, avoid looking at your account daily and log into it less frequently. The fourth investment bias on the list is the action bias. As humans, we're wired for action, and that's why individual investors have a hard time outperforming the market. They tend to trade way too often, which can lead to realizing unnecessary losses and missing out on potential gains. To avoid this bias, try to focus on a buy and hold strategy, or when opportunities in the market are not clear, just tell yourself it's okay. It's okay if you don't react and instead keep your focus on the long game. The last bias in today's video is recency bias. Every investment firm will have a disclaimer saying that past performance is not a guarantee of future returns. Yet our mind tells us something different. We tend to think that what has happened recently will continue to happen. That is why investors tend to allocate more money or even leverage into a soaring market, buying investments at a premium. When markets are dropping, investors cut their contributions or run towards the exits instead of buying when share prices are down. We are all guilty of having one or more of these biases, and the first step to solving a problem is to acknowledge it. A good investment advisor is there to help you implement a long-term disciplined strategy and steer you away from these common mistakes. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.